I would like to welcome our esteemed moderator and panelists for the session to the dais. Our moderator for the session, Ms. Madhura Mitra, Executive Director, Climate Change and Sustainability, PwC India. Our panel members, Mr. Rajiv Anand, Deputy Managing Director, Axis Bank Limited. Mr. Satish Mandhana, Senior Managing Director and Chief Investment Officer, Eversource Capital. Mr. Abhishek Poddar, India Country Head, Macquarie Group and Managing Director, Macquarie Asset Management Real Estate. And Ms. Kavita Saha, Managing Director, Head of Infrastructure and Sustainable Energies, India CPP Investments. Over to you, Ms. Mitra.
Very good afternoon to all of you. We are having this session in a very, I would say, important time because we have just finished the 20th Global Conference of Parties, COP28 we call it. And what we have seen when the entire world is trying to debate upon the text that has come out as an outcome of the COP, it says whether, the world will phase down its fossil fuel usage instead of, talking about phasing out of fossil fuel usage. And we are trying to debate on that, whether it should be phased down or phase out, whether we should transition away or we should transition from. So we're debating a lot on the language that has been used in the text. But the most important part of this whole, phasing out or phasing down is that we are talking about certain measures which are extremely CapEx and in certain cases both CapEx and OpEx intensive. India, for example, historically, we have focused more on energy conservation. And when we conserve energy, the good part of that is that there is cost saving because there's a cost associated with energy, and when we save energy, we can save cost. But when we are trying to shift from coal or from fossil fuel to some other form of energy or some other form of fuel, be it green hydrogen or natural gas or even biomass that Mr. Mukundan talked about, there is a capex associated with it. Now, again, going back to the context of COP, we have seen that there have been pledges. A lot of funds have been announced, and globally, we also saw some of the innovation in terms of catalytic funds being announced by Asian Development Bank and all. So this kind of brings me to the context that, and I will first go to Mr. Poddar. Given all these funds, and historically we have seen that, one of the major problems that we have faced in India, is accessibility to these funds. Sometimes the system is so bureaucratic, the process is so bureaucratic that though there are funds, the proponents, the project proponents are unable to access those funds. And because you are coming from a group, an international investor group, and you are also focusing more on climate finance, and also you have talked, about a lot about private-public partnerships. So from, two questions actually together. One is, how do you think these funds can really work? That's number one. And second is that because you are focusing on public-private partnerships, how do you think blended finance can play a role, when we talk about climate financing? So over to you.
Right. Thank you. Thanks for the question, and thanks, Bombay Chamber of Commerce, for having me over. I had the privilege of being at the COP for the first 4 or 5 days, when a lot of discussions around this happened. I think to answer that question, let me put it in the right framework, right? Which is most of the analysts agree that to even give us a slight of chance of 1.5 degrees by 2030, we need to deploy at least $4 to $5 trillion per annum on the climate side of things. That's fact number one. Fact number two, we saw the maximum, the highest investment in climate coming through right now, which is around $1 trillion. Great number, just 25% of the overall requirement. The problem and the need is way too big to be addressed either by government, by philanthropy, by private, or the public sector. And hence, everyone needs to come in together. I think that's as the thematic was very evident, especially at the COP28 itself, and in many such discussions as well. The aspirations and I would say the impact that different kinds of funds or different source of capital can make is also different, right? A private commercial capital at the end of the day will look for commercial returns in a manageable risk setup. That's fundamentally what a commercial capital will look like. However, when you look at climate financing, when you look at renewables, for example, more mature technologies using enough of private capital going in, enough of lenders like Axis and others backing it up, that you don't need the public finances. At the same time, you have your emerging technologies like hydrogen, battery storage, even electric vehicles and likes of those, which needs to be de-risked in order to catalyze a larger form of private capital. And that's where the blended finance comes in very, very handy. We've had a direct experience of the same as we recently tied up with the Green Climate Fund, which is an impact investor, which is putting in $200 million of first loss equity, and we bringing another $200 million of our capital, raising another $1 billion of debt, and creating a platform of $1.5 to $2 billion to drive large-scale electrification, especially on the heavy transportation side. Now, how that got enabled is the $200 million of GCF then is driving in 1.5, almost 1:9, 1:10 kind of the non-GCF or the commercial capital. And that's what we need to do a lot much more, a lot faster. You're absolutely bang on. There's a lot of capital. There's a lot of need. The problem is the funnel that sort of happens. And this is also one of the clear topics of discussion, especially the MDB reforms, DFI reforms are very high on the agenda. Thankfully, the new World Bank President, Ajay Banga, is very high on his agenda, and I'm aware of some of the pressures that is there on some of these DFIs as well. So I think it's important that the speed of moving fast and providing access to these kind of capital becomes better. At the same time, the private capital also needs to understand that it's a different world, and they need to start appreciating the same. I'm actually more optimistic. I think things have moved. We can always crib about there's a lot much more to be done. Absolutely. Things are moving. There is a general appreciation that things need to move faster. Hopefully, we'll see a lot many more results in the future as well.
Yeah, and also that we have seen, one is that things need to move faster, but, over the at least one decade, we see that there have been a lot of instruments, right? Whether it's a sustainability-linked loan or a green bond, we see there is no dearth of instruments in the market when we talk about, financing, green financing. So, and also then on the contrary, we have these problems of accessing the funds and all. Now, keeping this in mind, I will go to the banking person, and I'll try to understand a little more about which of these instruments that you generally see in the market, have been the most successful, You can also talk about failures and why, if you think that a particular instrument has been successful, why do you think, that has been more successful than the other instruments? So, yeah.
Thank you, and thank you, Bombay Chamber, for having us. I think as Abhishek mentioned, I think the size of the problem is so large and is probably going to take us decades to solve for. I don't think we have the luxury of saying that we will do A and not B or B and not C. And I think we've got multiple instruments, multiple solutions that are being tried. And remember that there are various levels of risks that various players are willing to take, because ultimately technology is changing as well. The last word on, for example, on batteries has not been said. So for a commercial banker like me, that's not a space that we would want to look at as a naked risk basis. But perhaps we could overlay a guarantee and work through that. So we ourselves, we've done a green bond, we've done an 81 sustainable bond. We're working with Guaranco. We've just done a transaction with Vivriti on EV financing. And so therefore, I think, all of us here will use multiple options to be able to pick and choose the kind of risks that we want to take onto our balance sheets, or to be able to take some of that onto our balance sheets and, sell that down, or take some of that onto our balance sheet and overlay a guarantee structure, etc. So therefore, I am not overly concerned about either success or failures of any particular instrument at this point in time.
Okay, just a follow-up question, and But, like, is there any kind of mapping between the kind of instrument that we will use and with the kind of measure that we are considering, like for a, electric vehicle, a particular kind of measure will work better than the other? I'm asking you only, then I'll come to Mr. Mandhana.
So, EVs is actually relatively easy. We ourselves, we have committed that 5% of our two-wheeler portfolio will be EVs, and we will give, I think, about 50 basis points of benefit to consumers for them to make that switch from IC to EVs. Therefore, there it is, very straightforward in terms of, I mean, ultimately you're taking a risk on the borrower there. Easy to manage. But I think as you go, and Abhishek spoke about renewable. Renewable is now plain vanilla. I mean, when I bring a project on renewable to my credit committee, I mean, we have a 10-minute discussion, look at the promoter, look at the parameters that are being, put out on the Excel spreadsheet, and goes through quite easily. Because we've gone through a 10-year history, we've had a successful experience with renewables, and so therefore our ability to do more and more renewable to that extent is much easier. We've also committed that we will do 30,000 crores of incremental green lending. This ticks the box quite nicely, and we will continue to build into that. Even within that space, for example, on wind has not been a good experience for bankers. And now increasingly we are seeing, we're going higher and higher. Wind patterns are changing, so the plant loads are not as per expectations, and so therefore there's an element of skepticism as far as wind is concerned, versus solar, for example.
Right, understand. So I think this is more like a continuation of this question only, and to you, because you are primarily focusing on climate finance, and because this particular session is on climate finance, is there a need for distinction? One is, from one measure to the other, because when we are talking about wind, and when we are talking about wind with storage, when we are talking about green hydrogen, vis-a-vis when we are talking about a waste management measure, the measures are very distinctive, their outcomes are very, very distinctive, and also there is a need, to also distinguish general environmental measures from climate-related measures. So there are so many distinct measures there. Do you think that there is a need to distinguish, because sometimes we use all these terms, green finance, climate finance, in a very general manner. But as an investor, how do you make a distinction? Or do you think there is at all a need for distinction? What is your perspective?
Thanks, and thanks to Bombay Chamber for the invite. Very clear answer. There's a clear distinction between climate finance and ESG finance, if that's the question. Every ESG finance may not be a climate finance, but every climate finance necessarily need to be an ESG finance also. And climate finance is a finance which is being done to create businesses or help businesses, support businesses which are having a climate positive impact. So these are the businesses which are either helping to decarbonize industry or bring the resource efficiency in a circular economy. So that's a big distinction. And coming a little deeper into the kind of examples which we were just talking about, a pure hybrid versus a pure solar or pure wind, obviously the risk profile of each of these businesses is different. And as my colleague just pointed out, 10 years back there was a hesitation in terms of even doing a solar. And today they just take 10 minutes to decide a large transaction over there, because the industry has matured. It's in a different stage of the S-curve. Whereas today, if the same proposal comes with a round-the-clock where somebody is guaranteeing 85% PLF with the added requirement that every 15 minutes you will have a 50% of what you have guaranteed coming into picture, every lender will have to go through thoroughly in terms of have they really optimized, will it really work, or is the costing coming right or not. And it will take a little time to mature that segment. And there the role of a blended finance, which you talked about earlier, and which you also hinted, comes into play to really accelerate this whole movement around that. But coming back, the need for a climate finance is huge and humongous. And I can also tell and share with you people that climate positive businesses are profit positive businesses. If you start transitioning from your normal business activity to a climate positive business activity, I can assure you that you will be gaining added bottom line rather than having any kind of erosion in your bottom line.
That's wonderful to know. But again, a little bit of a follow-up question, because you both talked about, and also you, that when it comes to wind, when it comes to some conventional green measures, things are already in place. As an investor, you don't think twice when you are investing, because there are things which are already in place, the technologies are known. But for deep decarbonization, we're moving towards innovation, and many other newer technologies are coming in. For example, carbon capture and utilization, or carbon capture and storage. So proposal for such a, such kind of financing, if that comes to you, is there a process, is the investor community ready to evaluate and then take a decision, a quick decision on financing such, innovative technologies?
Can I respond to it first?
Yeah, please.
Yeah. So I think, as you pointed out, a particular example where it is emerging on the S-curve right at the nascent stage. The situation was similar 4 years back. If you talk about e-mobility in this country, there was no scaled e-mobility business present over there. And today, there are few. Blue Smart was being talked about by Jayant. There is a green cell, there is a lithium, who have emerged as scaled businesses. And now banks are coming forward to really say, okay, fine, we are going to support you over there. Initially, it was the DFIs who came out initially to say, okay, we'll provide a lending support to you over here. So if the question is, will there be any hesitation in the investor community? Right. Within the investor community, there are risk takers, and there are funds which are purpose-driven funds, for example, a climate fund. Climate fund won't hesitate in taking that risk. Obviously, they will see all mitigating measures to be put around to ensure that it becomes a good investment rather than an investment which is to be rude. On the other hand, the lender's lens may be very different. And lenders may say, okay, fine. In a normal circumstances, I would have been happy with a 70-30 debt equity, but now I'm happy only with a 35-75 currently. Right. And also, it might be a situation where he don't want to say, and we have received those answers, where we'd like to see this industry to evolve a bit before we can come in over there. And there the gap comes into picture. Right. And the only way the gap can be filled is again to say that, okay, either you put 100% equity to prove the business model, have the proof of concept coming into the picture, satisfy the person over there, and then take out your equity once the things have been proven over there. And that's happening in many of the businesses currently, which are all climate positive businesses.
Okay.
Not my job, boss. As a commercial banker, I don't get paid to take on technology risk. So therefore, I want to see technology evolve, be commercialized to scale, and then that is when we will come in at that point in time. That process between innovation and the banker coming in, there is enough funds that is available there, private equity, venture debt, what have you. It's their role. They get a disproportionate share of the risk as well. But technology risk is not something that banks would take. I want to just re-emphasize that at the risk of stating the obvious, when we are doing green financing, the focus is on financing, which means that I want to ensure that my money is coming back. Understood.
And this is very well put. And
I
this
think I'll just add that it's not only the technology risk, which is a major risk when you are evolving into different areas. There's a scale-up risk also. There are situations where the technology is proven, but they are proven at a different scale versus the scale at which you are going to implement in this country. And that's again a big risk. It's not a small risk, and most bankers are not comfortable with that risk.
Understood. And that actually brings me to you, a slightly different question. But, historically we have seen that, in India at least, when even the renewable energy related drive was also new, carbon market played a very crucial role, even at that point in time, early 2000 and all, because there was a mechanism under the Kyoto Protocol and many, and we have seen deep decarbonization at that point in time, thanks to the existence of carbon markets. So do you think even now, carbon market can play a role? Because there's a change of scenario, right? Earlier, we didn't have any target to meet. Now we as a country, we have a target to meet. So there are restrictions on the flow of carbon credits. Keeping all these things in mind, How do you think, or do you at all think carbon credit can play a role, in at least for, the initial phase of, when the technology is picking up and it's not there at scale? Do you think carbon market can play a role, and what kind of carbon market, whether it's an international market or a domestic market? So wanted to understand your view, from that perspective.
Yeah, thanks. And I think there are a number of nuances to the question. So when you talked about carbon market mechanisms in India in the early days of renewable energy, it was more as a means to create that incentive for people to get good returns in a scenario where renewable energy was getting priced at 5 rupees, 6 rupees, 11 rupees, 15 rupees. This was a means to actually give them something extra and get better project IRRs and incentivize people to invest in renewable energy. I think that problem statement has changed a bit because now, since the Paris Agreement, you have more than 11,000 entities which have committed to net zero goals, and almost 42% of the Fortune 500 companies have significant near-term goals towards reducing their carbon emission, right? Now, this is like a very, very significant target. And for achieving this target, a number of things need to come together. There has to be an enabling regulatory framework. There has to be a change in corporate and consumer behavior. There has to be the desired level of investment that people spoke about. But at the same time, I think there also has to be a mechanism whereby, some of your abatement, because some of these are longer term shifts, that some of your near term abatement can happen through purchase of carbon credits, right? So I would say that at least in the near term, in the journey first to 2030, and then from 2030 to 2050, where a lot of these entities have committed to net zero goals, there is going to be a significant room for carbon credits. And in fact, we believe that between 2030 and 2050, you might actually see an accelerated requirement for carbon credits to achieve some of these net zero goals.
Okay.
So,
in fact, I know I would like to go to Mr. Poddar, just, in continuation to, her response, because you're also dealing with a large set of clients. First of all, what kind of projects do you think can go and enter carbon, market? That is one. And what kind of interest do you see, amongst your clients, in participating, whether they are interested to participate in carbon markets or not, or are they hesitant to participate? So what is your experience?
let me just touch upon there a little bit before Abhishek goes there. And I know I didn't answer the subsequent part of your question, but I'll address that after Abhishek answers. But when you talked about interest in purchasing carbon credit, and I can speak about this a little bit closer home because CPPIB itself has a net zero goal. And on a near-term basis, to the extent that we have unabated carbon emission in scope 1, 2, and part of scope 3, that we are purchasing carbon credit to the extent of the unabated emissions.
Okay.
Yeah, thanks. We do have a global carbon markets team, not in India. And I remember having a very deep conversation with them, both from Indian context and global context. Here's the messages that I get, which I would like to share. One is, currently, unfortunately, the voluntary carbon market is not that great. There are a lot much more carbon credit available, and the takers are very few. And you can see that in the pricing of the carbon, in EU, when during COVID period, it had gone up to, I think, $10, $11, it's just really crashed.
Right, it crashed.
The other element is there are always issues, concerns about, how true is that? Is that true really carbon
Quality
abatement? What's the definition? And the moment you get into all the definitions of carbon, every country, every region, everyone is coming up with their own self, right? I think there's a lot much more excitement, or I would say anticipation on the Article 6 of the carbon, which sort of have come into fray, where at least now we're finding bunch of countries which are ratifying, and are saying Singapore, for example, or Norway and Sweden, which are now looking at buying carbon credits ratified by the countries under their NDCs. So that seems to be a lot much more exciting part of the carbon, getting into a sort of bringing in a more structure at an international cooperation level where there's a better taxonomy that will emerge, the individual carbon credit contributors sort of come in. So there's lot much more hope that is coming onto this. In terms of the projects, I would presume it will vary, and fundamentally it'll come down to the buyer of these carbon. Carbon market is also evolving. There's no one carbon. The color of carbon market and carbon credits has also started to emerge, right? So people are saying renewables, I don't need a carbon credit. What's great if I have to pay for it, but that's anyway a commercial capital going in. Why do I pay for it apart from just meeting my goals, right? We are, for example, one of our teams are working on savanna grassland forestry and how to use, through use of some very innovative processes, the burning of savanna frost, grasslands comes down. Now that's interesting because there's a significant reduction of carbon emission into the environment, which cannot be done the other way around, right? So there are all kinds of new innovations that are started to emerge. It's very small. I don't think a project is gonna become viable purely dependent on carbon, but this is two points that was being spoken about earlier. The problem is huge. We have to find all of these as solutions. It's only when some of these come together that we'll be able to move forward.
Okay. Yeah, please.
So as Abhishek pointed out, there's an example where the financing part, though not the complete financing, but smaller financing is being talked about. I'd like to point two things. One, obviously this whole carbon market and carbon-related industry and ecosystem has learned a lot over the last more than a decade. And there's a huge amount of learning which exists, and deliberations in the COP28 and the deliberations otherwise in various nations currently are at a stage where they are saying that this instrumentality has to be used as one of the means of finance to doing the project. From a situation where we used to put up a project, projects used to start, and the verification used to take place a year down the line, and 2 years down the line you get an allotment, and then you are looking for a buyer to make it happen, to a situation where they say, as a part of the project startup itself, you should be able to get a financing because there's a carbon abatement which you are going to do, and you're going to create a carbon credit. So there's a mindset change which is happening. The second change is obviously the technology is helping a lot in terms of this deduplication, which was a major issue in the past and coming to the fore. And as Abhishek pointed out, Article 6, within Article 6, Article 6.2 and 6.4, 6.2 is significantly ahead, as he pointed out, with the bilateral countries. 6.4 is something which is evolving, and in this COP28 we were hoping to have a kind of a consensus around that methodology, which has not happened, but it is work in progress. By next year, rest assured that India will have a carbon market of its own, as well as a carbon market which is interconnected with the global market. And I was yesterday only with the IFTS Gift City, which is taking a lead in terms of creating a carbon exchange over there for this interconnection.
This is an excellent point, actually. And this interconnection we are all hoping would help, for international climate finance to flow in our country. So, continuing with this, carbon credit is one of the words. The other word that we are now discussing after the ministry's notification is green credit. So, I'll come to you. Green credit, which is like going beyond carbon and talking about other green measures. So, and do you think, because India will be the first country to come up with a market mechanism around green credit. It's a never seen before kind of a mechanism. So this is more like an open question to all of you. What is your expectation from this green credit mechanism?
The only thing I remember is I think our Prime Minister, Satish, if you have a better view, you should address, you seem to have. I was there at an event where PM Modi, along with, I think, Norwegian Prime Minister or Swedish Prime Minister did that, unveiling of green credit at Dubai. And all I can remember is a bunch of our desis really running into the podium and shouting it out chanting for PM Modi. I don't know much about green credit, to be very, very honest. Maybe Satish, you will have a much better sense. the sense which I got, and I think that's where it was possibly a step in the right direction, was go beyond just carbon. There are different, so to the point that I was talking about earlier, there are shades of green that have started to emerge as well, right? So it's not just about carbon abatement, and that's happening through some of these technologies, but different interventions that drive elements of improvement when it comes to some of the ESG aspects and sustainability elements as well, which goes beyond just carbon, right, would be covered as part of the green credit. How does that translate into actual commercial impact? I think it's still to be unveiled, if I'm not wrong. But maybe, Satish, if you have some views.
No, I don't have better views than what you just described, Abhishek. You're right, I was also there, and this is something which was not disclosed or deliberated internally before the announcement happened. But it's a step in the right direction, because just to give the granularity of this carbon, even if you talk about just carbon, a carbon which you are storing in a biochar, which gets stored for multiple number of years, versus something which you store, which will get again regenerated within a few years, there's a distinction. And the international buyer is making the distinction over there. They're making a distinction with respect to a carbon credit which has got generated where the ESG was of a very different order and the social benefits or and number of SDGs were involved. They're making the distinction. So India has seen that the investor is making a distinction which is beyond just carbon in terms of equivalent CO2. Prime Minister Modi took a lead in terms of saying, okay, call about the green credits, which will actually encompass all the distinctions which are being done informally, has not been formalized. Probably a framework will emerge going forward in the international community to say that this is green credit. But early days.
Yeah. So it's more like a forward-looking statement that has come from the Prime Minister. Now, taking this cue, because we have seen if you just stay a little bit more in the market mechanisms, we have seen that there have been a lot of uncertainties around how much would be the demand, and you talked about having a financer early on, right in the very beginning, so that we can hedge the market risk as much as possible. So keeping this in mind, do you think, one of the good things that happened at the COP was this catalytic fund that ADB announced, because it is kind of primarily trying to, generate demand in the market. So do you think such funds, would help, or do you think, or India, for example, if India is coming up with a national market mechanism, how do India, as a country should get ready for such funds so that if there is no demand, we have a contingency planning? Or should we have such proactive funding mechanism to generate demand in the market to start with? So how helpful these catalytic funds are, in your opinion? So I'll go to Mr. Mandhana first and then all of you.
So I think you're referring to a chicken and egg story here, whether the fund come first or the ecosystem which gives the comfort to a fund to come first, kind of a thing. Because unless you create a desired ecosystem where funds becomes comfortable in terms of the right deployment, they may not come. On the other hand, you may not have an ecosystem because there's no examples in the fund available over there. So this logjam has to be broken. And easier way to break that logjam will be a patient fund which comes and waits to make it happen. I'll give an example in history. An IDFC got created in this country in 1995 as a dedicated infrastructure funding institution. There was no commercial infrastructure available in the country. Government of India, along with the ADB, IFC, GIC, World Bank, took a risk in a way to say, okay, let's create an institution. The need was very clear. Purpose was well noble, well defined. It took IDFC nearly 3 years to start disbursing, and they took the hard work of creating the first concession agreement, which is bankable. First set of laws and regulatory framework changes, which makes the system bankable to start having the thing. So you might have a situation where the fund is there in existence, and the framework has to evolve so that now it can start doing the thing. So that's possibility.
Right, very important. Ms. Saha,
I would just add on to that, because, the process, the standardization of mechanisms by which you measure the availability of data, all of that is super important, right? And as Satish rightly said, that you can be visionary, but until you have a solid execution plan to back that vision, it will be a limitation.
Right. you'd like to add? Yeah.
I think one of the things is there's a lot of money that is being created in climate funds, ESG funds. Multilateral agencies have commitments to these let's say causes. But getting to that money is not easy.
True.
And I think it takes ages, even for a large institution like us. It takes ages for you to engage.
True.
Then the due diligence process takes time. Then they make up their mind. Then pricing doesn't work. And so therefore, I think being able to create a bridge between this money and the need for that in India, in some form or the other, I think is super critical.
Maybe before okay, please.
So I think when we talk about the green finance, and we should not be just looking, obviously India as a country requiring a huge amount of resources will have to seek external funding over there. And there may be impediments, and which are real, as he just pointed out. But there's a clear need and an actual possibility of channelizing domestic capital into a green capital, which has not happened. And the moment we start thinking around that, also in equal measure as we are thinking around how to channelize the external capital, the green capital into India, I think we'll be solving the problem to a large extent.
Yeah, this kind of brings me to one very important perspective. Okay, please
I
add.
think the problem is that ultimately, as large lenders in this country, we've got to do what is right for India. I met the coal secretary the other day. We will continue to produce coal, increase production on year-on-year basis till 2045. And I think we will continue to increase thermal capacity into the foreseeable future. That's the reality. I mean, all of us have, 2 mobile phones, 2 iPads, Apple Watch, whatever, everything needs to get charged. So therefore, demand in a growing economy like ours will continue to increase. And so therefore, getting the balance right of doing what is right for India and keeping my investors, my correspondent banking relationships happy is a balance that we are playing on a regular basis.
Right.
But I think it's an important nuance that large lenders like us are grappling with on a daily basis.
Just speaking on the point that you made around, converting domestic capital into green capital and all. What we have historically seen here also, some of the domestic funds, for example, the National Adaptation Fund for Climate Change, it remained more or less unused. A few projects we saw, but the scale was so limited that, we couldn't really perceive that there was a change, that was made because of that particular fund. So now coming to this, and because I talked about adaptation here, I wanted to understand that most of the discussions that we have had so far, we talked about green, we talked about, renewable energy and all others. But what about adaptation when we are trying to deal with the climate risks that are so perceptible nowadays? We are kind of facing a cyclone or an intense, climate event almost every day. In Kerala, we saw a 100-year flood is coming back every alternate year. So now, we can't really now solve the problem by mitigating greenhouse gases. We need to adapt. So we all know, we are aware of the situation, but we still see a very huge gap between adaptation financing and mitigation financing. So why do you think, we are in such a position now? And when there is a fund which is there, but we are not using the fund, so where is the problem? Where does the problem lie? That is first. And do you see a solution in the near term? So I'll come to whoever would like to, because there's a question common to all of you.
Again, this is, as always, there are nuances to all of this, right? I wish the answer was so simple. First and foremost, a right commercial model around adaptation is still to be found. Let's accept that, right? By definition, adaptation means changes happened and now you're trying to minimize the impact of the same.
Right.
So that's fine. Or changes will happen. And so I was about to come to that, right? I think there are 2 aspects to it. One is and Kavita and I, both of us will be able to very well identify with this. When we're making very large infrastructure investments, for example, roads and otherwise, adaptation is inherently assumed as part of our investment. You know, when flooding happens, when once in 100-year flooding happens every year, there's something wrong, right? So fundamentally, when we're doing our diligences, fundamentally when we are managing our assets, we are investing capital in adaptation. Now that doesn't get captured anywhere as a separate adaptation investment, but that's happening.
Okay.
That's part of the course itself. The second nuance to this is, however, there's much more needs to be done when it comes to adaptation side of things, right? And I think that's where, at least, I've started to see a lot interesting models emerge, you know, and this is what Satish was also prompting. Future sort of, you know, businesses, let's say, related to better climatic predictability, right? An impact of climate change on sowing patterns of agriculture and likes of those, right? So there are many businesses, digital-led and otherwise, that started to emerge, and there are funds that have started to go after it as well, right? So I think that's the element of it. To your specific point on there is a national adaptation fund and why has that not been addressed, that's a bigger problem that we've been talking about. There are many of funds like those. It's just impossible to get access to the same and for what shape and size, right? So I'm a firm believer that if government or public money wants to do anything on its own, that's primarily for the larger good of the society. Let that be in a grant or a social good side of things. The moment it needs to get into a more business, commercial side, purely from the efficiency of allocation, you need to get private sector involved. Otherwise, it becomes a very, very tricky situation.
Okay. But I do have a follow-up question when you say that, adaptation is an inherent part of your financing. So do you mean that when you are deciding on a particular funding, you are also carrying out a systematic climate risk assessment and analyzing the risks and then getting into resilient infrastructure?
Absolutely.
And this is how you're doing. There's a process that you are following.
Absolutely. And when we're not doing it, later on in our investments, we have had to do it. Without getting into details, there is an investment where we made where there was so many flooding, we invested. It ended up investing $5-6 million purely to take care of some of the adaptation. So it's become part of the course now.
Yeah, and I think in the world of infrastructure and asset-heavy investments, you don't have the option of picking up your asset or shifting your business elsewhere, right? If you have a building somewhere, that building is going to remain there. And if that area is going to get impacted because of adverse climate events, then, if you have not scoped that out and you have not priced that in, then your investments are not going to do well, right? So I think from last year onwards, we in fact had, while we were always doing it as a part of the diligence, but we have evolved much more formal systems to address both the transition and physical risks of our assets. So first of all, to evolve our thought on whether we should be investing there at all. And then if we are investing, what could be the range of outcomes, depending on, probability of those risks playing out, and then taking a very conscious investment decision.
Okay.
I'd like to add that adaptation, most people don't understand. And as Abhishek just pointed out, it's an integral part of the large investment Macquarie does globally. And any infrastructure fund, be it Kavita's or anybody, today cannot afford to not to do a climate risk assessment and how this project is going to get adaptation measures in the project. I'll give you a few examples in our context. All energy efficiency projects which we are funding or somebody's funding is a part of adaptation, because if you are trying to minimize the energy uses with a grid which is more than 70% thermal, you are ensuring that the change is coming down and you are making yourself in a situation where the energy requirement for the future is going to be much lesser than what it was today, and you are adapting yourself around that. Take the case of a business where the smart water meters are being installed in the large complexes. Our empirical evidence is the moment we install smart water meter in a large complexes, which is having more than 50 to 500 flats, the actual consumption of water comes down by 30%. Now, conserving water in urban India, where more than 20% of the supply in most cities in the country is through the tankers, because the municipal corporation doesn't supply the whole water. And we all know about the surface water limitation and how the earth is going to get starved of it. Is an adaptation business. But ask us or ask anybody, have we really classified that as to be adaptation funding? We have not done that. So if you start, first of all, creating an awareness around what adaptation is meaning, and there'll be enough takers who will come forward. But if you create a fund and there's no understanding about what exactly this is made, obviously there are no takers around that.
Understood.
So to the question that you asked, I mean, I think, on the corporate bank side, ESG risk is embedded into every assessment that we do. And, I think that's something that we've been doing over the last many, many years. But I think increasingly it is now becoming as important as you see, our retail pools. So therefore, there is floods in the hills. How many borrowers do you have there? What is the impact to them? Or, you're seeing, social unrest in Manipur. What's happening to those borrowers? And I think, and that is becoming increasingly important. And we're trying to build models, around that as well, to figure out, climate risk on and the impact of climate risk on our retail portfolios. Anyway, I think RBI is also doing some work around this and is pushing banks to be able to come up with models. I think they will be to some degree prescriptive as well, to come up with models in terms of how you're going to manage the risk on your, manage climate risk on your portfolios, both retail as well as wholesale. I think it is going to become increasingly important as we go forward.
This is a very critical point.
The mitigation, adaptation, etc. I mean, that's really the next level.
The terminology.
And I think we can only do various things, but there is an inherent risk that is sitting on your portfolio, and that's got to be either one is got to be measured, assessed, and priced for.
Understood. Just to kind of continue with this, I mean, you are sitting here, the investor community, and we are very clear that many of your investments are actually adaptation investments. When we see people on the other side, the corporate, many of them are hesitant. They are not so hesitant when it comes to, putting their money on a wind energy project, but when it comes to, working for a water conservation project or, climate resilient infrastructure project, we see they are hesitant, hesitant because they are not very sure of the return on investment, So do you think that there is a need to generate that awareness amongst those who will finally, play a very critical role, the private sector corporates, the Tatas and the, Adanis and the Reliance of the world. So do you think that there is a need to, communicate this understanding of how aware the investment community is, when it comes to adaptation, so that they are ready to take such risks?
I think they are all aware. The names which you just talked about, at least those names are very much aware. There's a need to showcase how investment in adaptation can generate returns. And I'll give you an example. Today, it's proven world over that if you plant trees in a city, you are able to bring down the temperature. And we are all fighting the temperatures because the temperatures are rising. There has to be cooling solutions for the homes. There has to be cooling solutions for the city or township over there. Now, by planting trees over there, today, CDM mechanism or the carbon mechanism exists where the carbon which is getting sequestered can be monetized.
Right.
Now, how you will be able to monetize that carbon which you are planting in the tree as an adaptation measure to bring down the temperature is something which needs to be highlighted. That is missing at this juncture. And when it comes forward, obviously you can see a plethora of people coming forward and saying, okay, I'm willing to invest into that, and that makes the change over here.
Mm-hmm.
But awareness in those names are very much there.
Okay.
I completely agree. For every term loan over a certain number, we ourselves go and do ESDD, environmental and sustainable due diligence. I'm very happy to inform the room here that I think over the last 3 to 4 years, we haven't rejected any proposal because it's failed from an ESDD perspective. So I think if you look at a BSc, BSc 500 set, I don't think, the awareness is an issue. They are committed. There is pressure from their boards. There is pressure from their investors. There's pressure from, bankers like us, We are pushing, scope 1, scope 2, we're now moving to scope 3 as well. So I don't think the issue is among the large corporates. The issue is really as you go into the SME franchise. I think the cost of compliance there is too big, and ultimately the question being asked is, what's in it for me? So therefore, I think all of us have a responsibility to take on as we think about the 7 crore SMEs that are there in this country, who really, I mean, there may be a handful of them who think about ESG and the impact that it is having on their businesses or they are having on climate. But I think that is going to be the challenge as we go forward.
Okay. Any view? Yeah.
Just to continue with what he just said, and there's a clear need in the SME sector, and I started by saying that going climate positive is a profit positive. And all the industry sitting over here, or the industry representatives sitting over here, they all know that if they adopt renewable energy at a higher percentage than what they're adopting currently, if they're adopting, their profitability increases, because the grid price is higher than the renewable energy prices. Today, the industry which is using the water, and the regulation around the water is changing a lot, and there's a requirement to measure, and you have given a particular limit beyond which there's a penalty which you come into picture if you don't really, you surpass that limit. Now, unless you adopt a water conservation measures over there, you are going to get hit negatively. So by adopting a water conservation measure, you will be becoming more profitable. Now, there may be a situation that the payback period for that particular change may be a 1-year payback period, or is a 3-year, or is a 7-year payback period. And depending upon the profile, they have to find solutions. How do you get somebody to fund partly to mitigate it for the 7 years, versus if it is a 2 years or 1 year, they can do it themselves without any problem as such. But it is a profit positive proposition to bring sustainability as a part of your core strategy. And if there are challenges around that, I'm more than happy to give enough examples around it. It's just a creation of awareness by the chambers and others to look into that direction and exemplify examples, people who have done it, so that others can emulate it.
Understood. So you have talked about examples. You have also talked about quantification of some of these benefits. I would like to hear your views as well.
On this topic, I would say that, institutions, there is, the immediate zone of influence, and then there is a larger zone of influence. So I think the immediate zone of influence is working along with our portfolio companies to help them drive the change in the areas that they influence, whether it is their areas of operations, working with local communities for adaptation measures, influencing their suppliers, and over a period of time, driving that change, as Rajiv mentioned, percolating it down. I don't think the large corporates are the issue, because they are certainly very climate aware, very ESG aware. And because of the fact that they have large institutional investors backing them, there is both the direct and the directed approach, but it is, percolating down to the smaller, the SMEs, who are invariably a part of some larger supply chain. So I think accelerating that process is where, both our work and our portfolio companies' work becomes pretty important.
Do you think, to you actually, when it comes to accelerating adaptation financing, partnerships, especially public-private partnerships, can play an important role? Because so far we have seen adaptation has been an issue which is mostly dealt by the governments across countries.
Yes, but as said, again, sorry, I'm repeating myself. It's for big ticket items, absolutely, right? Especially when you talk about, let's say, water conservation projects. Why isn't commercial capital coming on its own? It's not the lack of awareness, because inherently somewhere, the risk return do not add up. And that's where the public money can come in to either reduce the risk or to enhance the return side of things, right? To Kavita's point on the direct investment that is happening, and to Rajiv's point, that is innately private sector is adding to it. In certain cases, government, public money will be much better to go, especially when there are social causes, right? Finding new housing for coastal people to prevent them from water rise, right? That's a social problem. That's where the public money will come in. So I think we will have to categorize it to the requirement, and accordingly, the right kind of capital has to flow in there.
Yeah. Another example is dry land farming, right? The consumer is not going to pay more, but it is more a question of how do you make that viable, how do you enable flow of capital into something as essential as that. That is essentially public capital's job.
Wonderful example. So we don't really have much time, but before we, end this session, if anyone from the audience has any question, we have just 2 minutes, by the way. So,
30 seconds.
any question?
My name is Anand. I'm a startup founder, bootstrapped, addressing green, climate, drought, these areas, access, petroleum engineer, all the good stuff, fun, trading, this, that, tech, MBA. Question about scaling climate in India, climate finance. I know you address some of this, but it is still going to be a factor of monsoon, right? If the monsoon fails, scaling won't happen. Next year there's a flood, the scaling may not happen. So how do you, if not circumvent that, how do you work within that? The risk, I'm looking from the risk side, because that's what I'm trying to focus on.
Would you like to answer?
Sorry, the question is on agriculture.
How do you quantify a risk every year? When you're trying to scale for climate finance in India, we are still a monsoon-dependent economy, monsoon-dependent society. 1 year is a drought, 1 year excess rain. Like this year, perhaps June was dry. So you could do different things about the financing. RBI's home rates are this and that, but you still have to get good returns, and that will depend on the monsoon, right? Everything is a monsoon-dependent.
Is it Rajiv? Maybe you.
So I think the dependence on monsoon has actually come down in this country. I'm not saying that for a moment that the monsoon is not important, but thanks to check dams, canals, irrigation projects that have happened over the last 10 to 15 years, the impact of a bad monsoon is significant. If you look at data over a 10-year period, the impact of a drought on overall GDP is relatively smaller as compared to what it used to be, let's say, 10 years before that. It does still have an impact. If you have 2 bad monsoons, yes, that's when, in a sense, all bets are off. But all I want to leave with you is that the impact of monsoons on the economy in general has actually come down over the last few years. And the point that you make is very valid. Monsoons, not just monsoons, but both spatial and temporal dispersions is important as well. And as we just spoke about it, you could have droughts in one part of the country and floods in the other part of the country in the same month.
Correct.
And so therefore, how do you deal with some of those issues? That is a reality that all of us have to grapple with.
Gracias.
And just to say that the global community in the COP28, again, there was significant discussions around insurance companies taking a lead in terms of providing additional products to deal with this climate situation. Because the climate situations are going to be worse going forward. They're not going to be less, because if we don't stop these GHG emissions, we are going to see more floods, more droughts, more unnatural things happening in the nature. And therefore, there was a provision to say that, okay, the insurance company should come out and create bigger products for the climate-related risk.
Some years back, the insurance companies did show the way with cat bonds, so I'm not sure that's a good direction to go into, right?
I think we are
Thank
more
you.
or less
Is there-
over with the time.
Is there opportunity for that one last question? Is it okay? At the back.
Please, please.
Yeah. So thank you for this opportunity. Thoughtful discussion panel, and very grateful for bringing in very important points here. One important point which all mentioned and which has been a lingering question, that the climate related data and how carbon footprint is being tracked by all of the stakeholders, and how do we monetize the whole thing? Now, we keep hearing that we need a system. So who do you think, which is that stakeholder which will play a critical role to bring that system into reality, one? And second, how do we ensure that there is enough authenticity to the whole system that it doesn't end up into an instrument to further just mint money but not really take responsibility?
No, I'm not here to answer this, but any viewpoint from your side?
I can add, again, multiple things, right? One is self-regulation. There is a lot of issues on greenwashing. Many of the institutions like ours are becoming extremely worried about greenwashing. You would have caught the news. EU is going after Unilever, for certain claims on green. So A is that aspect, which comes to, how well you are sort of claiming part of it. Second is the taxonomy. Thankfully, there's a lot much more of alignment that started to emerge on how do you classify, what's green, what's not, what's abated, what's not part of it itself, right? I think the point about the system of capturing it is there a more central system where you're capturing reporting and likes of those kind of things. Maybe that's a process of evolution. I think different elements, once the Article 6 and more bilaterals between the countries start coming in, and a few others, the system will evolve. Whether it's government-led, whether it's a private sector, some startup left, the UPI entire digital public infrastructure came because government provided a nudge and significant other folks sort of caught up to that, right? I think, at least in my mind,
only
it's
thing
more
we
about
can say that the system is under process. We will soon see that there is a system driven by the government.
So that people have clarity that by what time you are
I can't talk about those timelines on stage, maybe separately. But yeah, very soon you will see a very comprehensive system coming here in India.
So I think to answer it squarely, the government of India has taken upon itself to ensure that there is a vibrant capital carbon market in this country. Project has been on for a while. A Bureau of Energy Efficiency was made an agency. There's a separate set of government beings which are attached to it. And as she said, it is supposed to be very soon now unveiled and for the users.
In the new year, you will have new hope. But this particular session actually brings us, a lot of hope, I feel, a lot of positives.
Yeah, I would like to answer this point. It's a very interesting point raised. The system is already in place. The government authority or the PSUs, those who are monitoring both for the carbon footprint point of view, how much energy we are consuming, whether it is a fossil fuel, both in the oil, coal and all, etc., including also the other terms of energy, how much we are consuming. It is being monitored, measured, and what is the footprint, it is already evaluated at the central level. But thanks to the SEBI who has introduced this BRSR, the top 1,000 company who consumes majority of energy is also being in the public domain, though we can say that it is scope 1, scope 2, scope 3, how much it is there, but it is being measured. System is in place. Only thing is that system maturity is happening day by day as it is coming.
We were talking about the carbon market system.
Carbon footprint.
Not footprint. It's a carbon market. I thought that was the question, whether we can monetize it. And without a vibrant carbon market,
that's true.
Monetization cannot happen. So we are at a stage currently, the government has to come out and say different industries which are hard to abate industries has to follow a decarbonization path.
Right.
And then people who have been able to not follow it have to buy it. People who have followed it will get rewarded and the trading will start.
Absolutely. Indian carbon market, right.
And I thank you, very, very much for sharing your insights. This has been a very, very interesting session for all of us. A session where we have learned a lot from all of you. Thank you very much.
Thank you. I would like to thank you, our speakers and moderator, for the thought-provoking deliberation and panel discussion. May I now invite Mr. Ritesh Tiwari to present a memento to our panelists and moderator as a token of appreciation. To Mr. Rajiv Anand. To Mr. Satish Mandhana. Mr. Abhishek Poddar. Mr. Abhishek Poddar. Ms. Kavita Saha. And Ms. Madhura Mitra. I request all the panel members and moderators to stay back for a group photograph. Sir, come ahead.
You're the one who invited us. Come here, come here, come here, come here.
Thank you so much.